My name is Rhys Christian and this Screencast is all about journal entries. The journal entry is the first record of any transaction, and it formalizes the reasoning to support accounting transactions. An accounting transaction is any economic event that affects the assets, liabilities, or equity accounts of a business. Each journal entry describes the date of the transaction, the accounts affected, and the amounts debited and credited. There are 3 steps to writing a journal entry. Step 1. What accounts are affected? It is important to identify the affected accounts correctly to ensure reliable and error-free records. For example, if a company makes a sale and receives cash, this means that the affected accounts are sales revenue and cash. Though if a customer paid on credit, the affected accounts would be sales revenue and accounts receivable, because they have not yet received payment. While the difference does not impact net assets, the distinction is essential. Step 2. What debit and credit entries are required? Debit and credit rules require balanced records so that total debits are equal to total credits. When asset or expense account increases, the amount is debited, and when they decrease, the account is credited. Liability, equity, and revenue accounts work the opposite way. When one of these accounts increases, the account is credited. When they decrease, the account is debited. This can be confusing to begin with, but one way to remember the difference is simply through the expanded accounting equation. Assets equals liabilities plus equity plus revenue minus expenses. This rearranges to assets plus expenses equals liabilities plus equity plus revenue. Here you can see that the left side follows the increase of debit rule and the right side follows the increase of credit rule. Dividends follow the same rules as expenses because as they both increase, the equity of the company decreases. Step 3. Record the journal entry. Record the entry in the correct journal table format to show date, accounts debited and credited, and amounts debited and credited, with an indent used on the credited rows. Expanding on the previous example, if on March the 10th a sale is made for the cash amount of $1,000, the date would be recorded as the date of the transaction. In step 1 we identified the accounts affected would be sales revenue and cash. Then following the debit and credit rule, in step 2, the cash account is debited as it increases $1,000, and the sales revenue will be credited as revenue increases $1,000. So to summarize, the steps are: what accounts are affected, what debit and credit entries are required, then record the journal entry in the correct format. Thank you for listening.